bridging the mindset gap between where you are right now and turning your trading into a business, and some of the things you can look at from what we call a simple, systematic, integrated approach. A lot of like what John was talking about in terms of that integration, like looking at all the different factors in your life, all the different realms that exist, and bringing all of that information into building a really tight, concise trading plan. And that's one of the key elements that we always talk about here at IDTA is how strong is your plan and how robust is that? So we're going to ask you some of those questions about that. Now, can everyone see my slides? Are they being projected from my laptop? Just make sure that's working. Just got to make sure the technology is working. Brilliant. Okay. So that's all working. Okay. Now, I love this quote. If anyone's done any work on themselves in their trading, the mindset work of the trading, there's some great mentors out there, and one of the guys out there is Jared Tendler at the moment, who's doing some brilliant work. But what he says, most mental errors in trading are derived from flaws in one's trading strategy. So what are you covering in your trading strategy? Are you accounting for all different variables that could occur while you're trading? And that's really struck me deep, that I find that even with doing the coaching work that we've been doing over the weekend leading into conference, dealing with the 4 different traders, we looked at, and we'll talk a little bit more depth about the mindset, but one of the things that was glaring was the strategy was, there was some real strength in the strategy, but then there was some gaps and it lacked a little bit of strength in areas. So sometimes we're quick to blame ourselves for being mentally, screwed up, which, trading, you talk to any high performance person, mentally it is challenging. All right. There's challenges in trading. We know that. And it's the real challenges we have is being prepared and organized for all those different situations that occur. So, these quotes here come from something I was looking for, when I was preparing this presentation, is one of the key quotes that a lot of traders say about how to be great, and some of the things that could really help. And these are the ones that really hit me and relate to the topic I'm going to talk about today. This is, if you want to check out these other quotes, this is the link I got it from, 17 trading quotes to skyrocket your profit in 2022 by Justin Bennett. But these are the 3 ones I want to specifically hone in on. And one is, if most traders would learn to sit on their hands 50% of the time, they would make a lot more money. All right. So you don't need to overtrade. If you can just sit and wait for the right opportunity, then you're in a good place. The second one was, there is the plain fool who does the wrong thing at all times everywhere, but then there's the Wall Street fool who thinks he must trade all the time. That's from famous trader Jesse Livermore, probably one of the most successful traders in the last 100 years. And this one here from Jack Schwager, who's the author of Market Wizards. And this is a great book, by the way, Market Wizards, because he talks to a whole gamut of traders from a whole bunch of different experiences, different specialty markets. It's a great read if you're only new to trading, just to hear about other people's experiences, like what other people have gone through in their role and how they've got to where they are, the ups and the downs. It's great to reference these other traders that have made it. And he says the hard work in trading comes in the preparation. The actual process of trading, however, should be effortless. And this is what John was talking about, doing the mental training, the live market replay, all the sim trading, all of those the steps to get you to where you're going is very, very important. And we sometimes forget about the preparation. We want to get straight in there, watch the live trading room and just put the trades on and just go for it. But we haven't really gone to the preps to really the preparation levels to be comfortable with the decisions we're making and be really truly responsible for those decisions we make. And I'm noticing that at the moment, just in my own life at the moment, because I'm doing a lot of sort of renovation work and stuff like that. And the preparation is, particularly when I'm doing new sorts of trades, which I've never, I'm not an expert at, it's the preparation time is the most important part to get the job done right. So I'm going to ask you a question, guys. So I want you to answer this in the Q&A panel, is what do you think is the most critical virtue that underpins the great traders? What do you think are the critical values or virtues that underpin great traders? And it can be, there's no right or wrong answer, but what do you think from your own experience? And I'd love to get some answers from some of our traders out there today. Experience, discipline and patience. Mo, discipline and patience. Patience, 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 discipline. Robotic. What did Scott say? Can we scroll through those Q&As, guys? There's been a lot of responses. Thanks, guys. Who's looking after the Q&A? Please. Thank you. Thank you. Patience and discipline. Okay, guys, we're in the right room because I've got the same answer. All right. Everyone says discipline and patience. All right. But there's also another element, which is your timing, which is that kind of that missing link that we sometimes forget about. If you have done any, have looked at any of Roger Hamilton's work, he talks about a model called wealth dynamics, and he talks about the trader profile. And the trader profile is someone who's very grounded. They're in the balance of being very mechanical, but they're also quite on the outward, more extroverted scale as well. So they've got a real balance of introversion and extroversion. So they know both sort of realms or elements, but they're very precise. And they've just got this missing link about timing. And a lot of that timing comes down to their preparation. They're so well prepared. They trust what they do. They are so confident in what they do. So how can you guys develop your timing? All right, and this is what we're going to talk about. What processes can you put in place? Also, another question I'm going to ask you, what is the most understated and most important aspect of any business startup? All right, let's think about it. If you've been thinking about setting up a business, whether it be a trading business or any business in the past, what do you think are the most important aspects of that business? Doing your homework, grit, the why, we found that today, your mission, your vision, very important. Understanding the risks involved, yes. Knowledge, having a plan, working capital, business plan, research, preparation. Interesting. And it's very interesting too that the people that are bringing the answers out are the ones that have featured in a lot of the awards too, which it's interesting as well. So there's a bit of a correlation there. So the people who are giving these answers are pretty much spot on. And two of the most important things I would say would be the working capital when you first start out, and having a business plan, which most of you guys talked about. But then there's that one element, and some people came up with it, was like research. Knowing their product. And what I talk about is specifications. Like, what are the specifications? Does your product, right, does your trading plan or the way you trade meet the market's needs, right? Can you plug your trading strategy into the market that you're trading? All right, so, are you someone who's looking for long time, going for large targets, but you don't have time to actually go for these large targets and sit in a trade for potentially 3 to 4 hours, right? So is your trading plan realistic? Is it fitting in to the market requirements, and does it suit your lifestyle or the time frame you have to dedicate on your trading? So that's just an example of how you need to look at your trading plan, how specific it is to the needs. So what does this mean? So when you consider the specifications of your trading plan, does it cater for all market conditions? Now, it doesn't have to, all right, but does it? Have you looked at how you're going to trade over different volatilities? All right, somebody talked about yesterday the VIX, all right, how do you deal with volatile conditions? Well, look at the PVI indicator. Have a plan for when the PVI is at certain levels. Like, I think Philippa yesterday had different targets for different PVIs, which I think was absolutely brilliant. So can you deal with the varying volatility? And a lot of people get themselves in a big strife when they first start, because they put themselves into the market and they don't account for different volatilities. They're not used to it. So they're trading their normal trading plan that they've worked with already in their simulation trading. Then they face with a day when they're trading live and it's high volatility, but they don't know how to react in those conditions. They don't know, how to have great risk control, or they're not taking into account how they're going to behave in those conditions. So be very, very careful or mindful of the volatility. Does it have a high opportunity of setting up in your session? So does your trade have a repeatability about it? Does the pattern show up enough for you to be able to trade that particular trade? What is the intention of the trade? Like, I'll give you an example. Go back to point 3. You might be very much a trend type trader, all right? And your trading strategy very much relies on trend trades, right? But as we know, a lot of the time the market isn't in a trending state. Like we saw on Friday, there's times when the market is a little bit choppy, all right, and slow, and then it'll start to trend. So does your trading strategy counter for these types of situations? And I want you to think about this, and I want you to write these notes down, like write these questions down to ask yourself, so that when you go back to review your trading plan this year, what do I need to change? What is the intention of the trade? We talked about that a lot today, John's presentation. What's your intention? What are you getting? What do you want to get out of the trade? Be very clear on the target and the risk. How likely is my financial target to be met in my session? Is the target realistic? And is the risk worth the effort? Sometimes we trade into these brick walls and we've got huge risk, and we just want to force the trade because we've been sitting in front of the computer for an hour and a trade hasn't set up yet, but we see something that's pretty good, hasn't ticked all the boxes, but we're going to take the trade. Was it worth the risk to trade into that brick wall when the risk was not worth the reward? And 7, does it allow for precision of timing for execution? So let's go back to one of the most important and understated things for traders or for any business person is their timing. Is the timing, precise? You may have your discipline and your patience all geared up, but does your trading plan allow you to be disciplined and patient? Does the strategy take into account those virtues that you need? As we know, patience and discipline are vital. And we're all, aspiring for those virtues. So let's talk about this integrated approach. All right, how can we look to increase our precision timing using a systematic integrated approach to your preparation? So I love this model that John mentioned about the integrative model, and I really thought about it. I thought, God, our trading, or my trading, I really do look at these other different charts, and it's like, how can I build that into more of an integrative package so it makes it easier for me to not to have to think all the time? Like, I can just go into my pre-trading plan or to my pre-trading session and just know what charts I need to look at and what's very specific that I need to focus on. So I'm not thinking during the trading process. I'm just watching and looking for the answers or the algorithms to perpetuate and to become real. So this allows that patience and timing. When you know what you're looking for and very clear, you can be patient, you can be disciplined, and then you can just really hone in on the timing, which is the key. So there's really 2 types of, and when I talk about frames of reference, it's looking at different things occurring on different charts. And I always like to look at like 3 key features or 3 things that are occurring on the chart as a potential form of failure, right? There could be 3 components of support and resistance that could be on the chart could be acting as a very good failure zone and could be a very good reversal opportunity. Then there's obviously an opportunity for a continuation of a trend as well. This is where you can start to look at your extensions and see if the market is moving off support, like the 25% extension I talked about yesterday, and if we're moving through beyond the 50 and then potentially going to go and test the 7,500 and beyond. So, they're the real two things that I look at. Is the market failing, or are we in a continuation type trend scenario? Now, what do we use? Fibonacci retracements, very important. Fibonacci extensions. The MDI, is a very important reference point. How far away from the MDI are we? Has the market got a high probability of going back to the MDI? Are we moving away from the MDI? So we're in a trend up or down. Watch the MDI, and on all frames of reference. So the 60-minute, the 15, and the 5, which is our execution chart. And then your leg counting principles. I always try to make sure that I'm getting in on that leg 2. If we're swinging on leg 2, which we talked about yesterday in my presentation, the market's swinging. So we're swinging off a stair step. So that's where your foundations are very important of understanding the stair stepping process and drawing your stair steps. Are we swinging off these charts, and how is the movement occurring in that leg 2 or that C leg? How's it handling the different Fibonacci levels? All right, so let's have a look at a couple of charts and look at this integrated approach. So I'm just going to go into the charts and show you an example. So I'm just going to work from a top-down approach. So I'll start with the 60-minute chart here. So the first thing I've drawn here is a fib retracement, and it's normally my 60-minute charts is like a brown Fibonacci color, but I've just got my normal 5-minute color here. So I just wanted to highlight the 50%, so you can see where the 50% was, and the 76, which is the brown one. And I won't talk about why the brown one is the 76. You might have to talk to Catherine Forder about that one if you ever get a chance. It's a great story. But anyway, so number 1 is the retracement level. Now, the next one I've done here is the extension. All right, so watch the extension on the way down. And what we're looking for is that resistance, or the market's holding off that 25 there. And I've got the 33 there, but mainly the 25 is all you need. And then what we're looking for here, the third thing was second leg of the push, retrace, reject. So the market, from that extension, the market stalls for 4 hours at the 100% extension. So there's something happening in that time where the market's finding a block. It can't move any further. So that's what we call a support and resistance level. That's specifically what we call a support level, because it's holding the floor up. So it's supporting floor. A resistance is a higher level. So it's like a ceiling in the market. All right. So, but if you look at the extension, you can see how the market respects these levels. There's an uncanny coincidence that the market goes back to the 25 extension and stalls and fails and then continues on eventually. All right. So that's the 60-minute perspective. And what I'm doing there, I'm looking for failure. All right. I'm looking for failure, and I've got 3 different points of reference. So I've got number 1, my first point of reference is the Fibonacci retracement. We've got a 61.8 Fibonacci retracement where the market has found support. I've got 100% extension on that 60-minute chart where the market has found support. And now I've got a pattern or a movement, which is my third frame of reference, is this stair step on this chart. So you can see I'm using a lot of information, very simple. It's not overly complicated. I'm keeping it very basic, but I'm looking at just 3 things. Sometimes you're going to get more factors as well. But if I've got 3 frames of reference, 3 points of reference, that's a strong area for me to look for movement. So let's go to the next chart, which is the 15-minute chart. Now, this is a bit of an expanded version, but one thing I can see on this 15-minute chart, you can see I've got a couple of different fib levels there. So you can see I've got this time I've got the 61.8 in maroon, so you can see, or brown. So you can see that one there, and the market stalled there. I've also got the 100% extension that the market's failing at as well from that 60-minute chart. So this is carrying over from the 60-minute chart over onto the 15-minute chart. You can do this very easily in your NinjaTrader platform. In your settings, you can set the Fibonacci to go onto all charts. So you can see what you've done on the 60-minute chart, bring it over to the 15-minute chart. All right. And then the final thing is the brick wall. I don't know whether you can see here, we've got this dotted line down here. This is one of the IDTA indicators, and that is another point of reference that I've got on this particular chart. All right, so you can see I've got 3 points of reference on that 15-minute chart. Now, this is a gold chart, by the way, a gold market. This is on anything. If you just purely trade indexes, it's the same concept. It doesn't matter. It's the same process. It's just a consistent process, but obviously it's got to be tested on that market. All right, now so that's, I've zoomed in, so you can see that better now, right? So there's a little bit more frames of reference here. So I've got 5 legs into this move. So I've got 1, 2, 3, 4, 5. So we've had 5 clean legs, which is getting a little bit exhausted. You're getting to that point where the market is, that's been quite a strong trend. Now we're coming into these brick walls and these Fibonacci extensions and these retracement levels, which are giving me these 3 points of failure. Now I'm looking for the market to now stair step away. Now you can see here the third point I've got here, I've got a static bar reversal trade. Now, some of the people who don't know trading, who don't know our strategy, this is one of our strategies, the static bar reversal, which Lockie mentioned yesterday. But basically, we've got a static bar reversal also occurring on the 15-minute chart at this similar area. So you can see we've got this whole area is acting as a failure area. So the best opportunity that I could see if I was wanting to execute in the market is I'm going to look for opportunities away from the market or back to the MDI is going to give me the best trading opportunities. So now let's go into the 5-minute chart and to see what's all happened. So this is all just, you can see I've gone from a bigger perspective to a smaller perspective. So I'm just going down from a top to a down approach into a more of a micro view. And this is what we trade. We trade the 5-minute charts. This is where we execute. This is where we place our risk because of the money and the leverage that's involved. We use the 5-minute as our execution chart. Now, what I've put up there, those arrows you can see on the chart, they're all, different type of 101 trades. Now, there's about, I think I've got about 1, 2, 3, 4, 5, 6, 7, 8, 9 101 trades over a period of about 3 hours that set up. Now, there's going to be other varieties of trades as well. So you could be sitting there going, oh, I would have taken that trade or I would have taken that trade. That's great, all right? I'm just looking at just basic 101 trades without any variance and not a huge amount of reference to micro Fibonacci levels or anything, but mainly the brick walls that we use. But you can see that there's 9 trades in that particular setup. Now let's have a look. Now they all weren't winners and they all weren't losers, so there was a combination. So there was a combination of 9 trades. There was 7 that were long, which means they were going up. So they were buying trades. They were what we call long trades away from the failure area. And there was also 2 short trades, which were back into the failure. So they were pushing back into the area. So there was a high proportion of long trades than there were short trades. So you would have been, if you were thinking about trading away from the market, you would have had a higher probability of getting a trade. But also another interesting factor is you would have had a higher probability of winning as well. So of the 7 long trades, 5 went to 55 ticks to 120 plus ticks. 2 were stopped out at 24 and 44 ticks. So the overall profit was there in those 7 trades. So if you took all of those 7 trades, you would have still been profitable despite having those 2 losses. So you don't need to win every trade to be a profitable trader. Now, of the 2 trades that were short, one went 25 ticks and one also stopped out at minus 28. All right, so you could have still traded short, taken all of those 9 trades, but you would have been doing better if you traded the longer trades or went for the buy trades. So the conclusion is the strongest 5-minute chart trades were taking into account 3 points of reference on the 60, the 15, and the 5-minute charts. All right, so we were trading away from the failure. That was the strongest reference from all of those 3 frames of reference. There was probably a minimum of 3 reasons why trading away from that area was going to be strong. And you could see it on all of those charts. It was giving you reasons why the trade was going to be, or the trades were going to be stronger to the high side. The strongest 5-minute chart trades were long and therefore moving away from the failure with strength and speed. And we are short-term traders, so we like strength and speed in the market. We don't want to be in slow trades. We want to go with strength and speed, and that's why the timing of the trade is very important. Timing your trades, letting the market come to you, come to your areas, will allow you to get that more strength and speed. All right, that's the whole intent behind these strategies. And the third point was the strongest short trade was the one that won out of the two, because there was a winner and a loser. The one that won was after 3 buying legs on the 5-minute chart, and it was on. So it was after 3 buying legs. So you were reversing the buying or the buying stair step. All right, so you were reversing that after 3 legs. And in the 101 course, we have a rule of 3 that if you want to look to see the market potentially stumble after 3 legs on the 5-minute chart. So that was occurring in this particular chart. Also, too, the second leg on the 15-minute chart was swing, so it was stepping down. So you had an ABC pattern, or an ABC structure was building up. So you're on that second leg, which I talked about, and also off yesterday's low. So you were actually swinging off a brick wall, which is yesterday's low, and also off of 50% of the 60-minute chart. And you had room, and this is the key, you had room to the next brick wall, all right? So you had nothing in the way, and you had room to make those 28 ticks or so to the target. So that's a very, very important example I wanted to give you of how there was many trades you could have taken, but which ones were the strongest trades out of that. But the preparation and the homework showed you that if you got yourself into the right position and you were waiting for the market to fail at those particular areas, that those trades were the strongest trades. So if we look back and we see, those trades, you can see those ones where you waited for ultimately the double failure over that period of time down around those areas. The strongest trades, you can see the speed and the strength of those last 3 trades were all very, very powerful and just went to huge profit, okay? That's the whole concept behind what we're doing. So, are you coming on? You're here. It's all good. Oh, I got plenty of time. Time's good. Okay. Now, words of warning, guys. With an integrated approach, be careful with being in a position coming into the open of a major market. All right. A lot of people get so focused on the patterns and the build-up of the trade, but they forget about coming in to the open, because sometimes news is around the open of the market, or sometimes there could be new traders coming on, putting on positions, and that can affect the technical side of your trading. So you might be reading the story beautifully, then all of a sudden a huge announcement comes out, or just the open of the market, just the effect of all of these traders coming in and putting their positions on for the day or for the week or whatever their long-term approach is, that can have an effect on the direction of the market in the short term. So this is why sometimes you just need to wait, all right? Don't, if you're in a trade leading into the open of a major market, maybe exit that trade and just wait. And that, if the market then comes back and agrees with the technicals, then you can still continue with your story. If it completely changes the situation, then you may need to reassess the plan behind the trade, all right? So just be mindful of that aspect. Do not discount the power of the market failing at a major fib within an IDTA brick wall nearby. So what that means, if you get a major chart fib, like a larger chart, like a 60 or a 15-minute or 240 fib, daily fib, with an IDTA brick wall, those 2 levels of what we call confluence are a powerful little recipe. So just watch if you've got room to that area. So often I see you've got a beautiful Fibonacci extension level up, moving up, and then you've also got a brick wall up there, like a pivot point or a gap, and you've got a beautiful combination of things. That is going to give you a wonderful target to go for and get out of the trade if you're in the trade. Now, if the structure is confusing and the 3 reference points are not strong or clear to you, be patient. Don't force a trade. The trade will come. All right. Sometimes you just need that missing link. You just need that missing extra frame of reference, that extra little piece of ingredient to go, yeah, okay, now it's ready to go. All right. So we never know exactly when the market's going to move or when the trigger will occur. All right. But let the market come to you. Because point 4, forcing trades does more psychological damage than anything. All right. And it can really put you back. That trauma that you receive from or you experience through forcing the trades can have a huge impact on your trading in the future. Just a couple of things before I finish off. There's a couple of other charts where I've used some frames of reference. You can see up here, we've got a combination. So the first circle you can see there, you can see we had efficiency, all right, into a brick wall, so the pivot point, and also a major Fibonacci level being a 38.2 off a 60-minute chart. And then we got a combination of static bar reversals and a 4-point turning bar off the brick wall. That is just such a beautiful combination. All right. So you had 3 reference points. You had the 15-minute chart giving you reference. You also had the you had the 60-minute chart, and you had the brick walls off the 5-minute chart, and you had also those patterns and signals, being the SBR and the turning bar. Then down below, we've got a great combination here. So you've got on the 15-minute chart, you can see markets failing here at the 50% extension. You've also got a 61.8 Fibonacci level as here as well. And also you've got the open, and you've, so there are your 3 points. And then once again, we get a beautiful static bar reversal with a turning bar. And then the market stair steps away and moves away from that failure. So there's a couple of examples of how you can use these combinations of frames of reference to help you find failure and great trading opportunities. This was from Friday night, and this was only a very short-lived short trade. But once again, I was watching this in the afternoon, and I could see there was a lot of things happening. You can see we had the first extension that changed the trend. This was still running from the 15-minute chart. And then this overlay is the 60-minute extension. So we had a combination of 15, 60 major Fibonacci levels all failing up here. Now, the thing about this trade, and this is a really good lesson, the market hadn't quite hit the pivot point, right? So if you did go short off here, you might have snuck away with about a 4 or a 6 tick trade on the S&P 500. But it probably wasn't as powerful what it could have been, because it hadn't quite gotten to that 3rd point of reference, hadn't got back up to the pivot point. So once again, a combination of the 5-minute chart brick walls are very powerful with these, with the 15-minute chart extension, and also the 60-minute chart extension. So remember, more frames of reference are going to make you trade a little bit stronger. And yeah, just finally, are we over time? Okay, just one thing I want to go to quickly. Just bear with me. This is a great analysis, because I know I want to build on from Lockie's, because he used in this session yesterday. He talked about the S&P trade that went long, the 5-minute trade. It took a little while to set up, but it was a sensational move. But what was happening was there was a great combination of things. We had the 60-minute chart was building. It had got over the 25 extension, and it was moving high. So it was stepping up on the 60-minute chart. The 15-minute chart, this was leading into the pre-market, right? So the pre-market had stepped down, but look where we failed on the 15-minute chart. We'd failed just before the open. We'd failed at the 161.8 on that what we call a complex retracement. So we did 2 legs against the trend, against the 15-minute MDI. So we'd failed there at that level, all right? So there's a really key frame of reference. Then when we look at the 5-minute chart, another thing is with that. Another thing is, if you look at this 50-minute line over here, that's coming from a larger extension. All right, that's from the 60-minute chart. You can see we got above the 50-minute extension on the 60-minute chart, and that gave us a sign that this market could be stepping up. But what we needed to wait was for that second leg on that 15-minute chart. If you waited for that 16-minute or that 15-minute second leg, that swing up, look at the response, right? This was the response we got. So that's where the market failed on the 15-minute chart, which is carrying over at the 61.8, leading into the pre-market. Then we had the attack on the high side on open. Then we had the response by the sellers. So we had the retracement. They failed. And then you can see the market just stair-stepped up beautifully. And then the market just went to town. Now, I got in on this trade. I got in a little bit too early, but I did stay in the trade. My risk was down under the failure point here. I did get in here. I bought there off a reversal type swing trade, a little bit preemptive, but if I could have waited and fine-tuned, I could have got in on a little bit a better level, like on a beautiful ABC pattern here, and it just would have paid magnificently. I was a little bit impatient, got in early, a little bit excited. We had annual conference coming on and I was all pumped up on Mountain Dew and I thought I could get a nice little trade. I had to wait a bit more patient, but if I could have waited and timed that entry of that trade, you know, I didn't need to get in too early. I just needed to wait for the market to fail, get back above the 50 and then start to show me some nice stair stepping on this chart. And you know, it was a beautiful setup, and you know, Lockie showed us the results, like the amount of trades we had when we established that the trend was in place. We had an amazing number of longs to the high side with efficiency and step and trend. So thanks guys for that. I hope you got a great amount of information out of that presentation. And once again, I think the key points is to make sure that you're looking at your different frames of reference. Very, very important. Defining your failure areas is super important. Integrating your 3 important charts. So for us, the 60, the 15, 5 is a great place to start. Waiting for your failure areas to hold up. This will develop discipline, patience, strong mental skills for trading, and so much more. So thank you, everyone.